Yes. So, hi everyone. Good evening. Hope I'm audible. Yes. So, yeah. So, hi everyone. So, welcome back to a new session of Jargon Buster Webinar Series. So, in this session, we are actually going to discuss a very practical challenge which most of the founders actually face in their business, which is related to working capital and kind of how to manage the working capital and how to kind of arrange for funds. Like, what sort of funding should you look in case of where you have working capital fund issue and all. So that is the topic that we are going to discuss today. So I'll start from the base. I'll make you understand like kind of how there is a cash flow issue happening in a business. What are the key elements that causes this reason, and what are the various types of funding options? Okay. So we'll start with that. So working capital and debt decoded. So this is the question. I mean, I have also taken sessions on this in the past as well. So you looked at your P&L. It said you made money. Then you opened your bank account. Where did it go? So this is a very like kind of typical question what I've seen with most of the founders. So when they look at their profit and loss account, they see that the business has made money. The business has made profit. But when we look into the bank account, there is no money in the bank. So this is a very, very, very practical scenario what most of the founders have come across. So we are going to address this question today in this session. So today's topic, like divided into two parts. So the first part is like working capital decoded, like what is cash cycle in a very plain manner. What is DSO, DIO, DPO, and CCC, which I will be explaining in the upcoming slides. Then how a profitable business runs out of cash. So the answer to the question which we have already shown in the previous slide. Then 3 internal levers. Okay. And the part 2 is debt instruments. What is cash credit, OD, working capital, debt and all. Then term loan and NCD, venture debt and revenue-based financing. And then one slide like decision framework, like which funds to use in case of the scenario that you are in. Okay, so this is going to be the crux of today's topic. In case you have any questions in between, or if you feel like it's a bit complicated, please feel free to step in between and ask the question. So working capital decoded. The numbers behind why cash and profit do not move together. So firstly, what we need to typically understand is the cash cycle in a business. Okay. So money goes out before it comes back in. The gap is working capital. So this you might have faced in your business. So if you look at a trading business or a manufacturing business, okay, the first thing that what they do is buy. They have to buy inventory or capacity. When I say capacity, it can be a factory, it can be a machinery or any sort. So for that, you're spending money. Then you want to make the product. So for making the product, you need to pay labor charges. You would be required to pay the electricity bill. Those things would be there. So at this phase also, you are going to spend money. Then at the third stage, you are going to sell the product. And in most of the cases, the sales happens at a credit. So your customer would be paying you after a while only. And then the fourth stage is where collection actually happens or collect. That is where you actually receive the cash. So you have spent cash when you buy the product. You have spent cash when you make the product. You didn't receive any cash when you sold the product. And eventually you collect money from the customer. Okay. So that is the cash cycle. So here, if you look, if you were starting from zero, until these two phases, okay, buy and make. So in these two stages, you have already spent the cash. But cash you got only in the fourth stage. Okay. So you needed some money upfront to run the business to generate cash. So that gap is what is called working capital. Okay. I hope it is clear. So if you look at any other business, be it a service business, for example, your client pays you only after the service is delivered. Okay. Just imagine there is you are a newly started firm or you are a newly started service company. And so you are not in a position to collect advance from the customer. So the customer would be paying you only after the service is delivered. But before delivering the service and collecting money from the customer, what you need to do? You need to pay the salary to your staff. So your cash is going out there. You need to pay rent for the office that you're operating out of. So again, cash is going out. But you get the money only after few days. So same issue is there in a service business also. So in most of the business or in majority of the business, unless and until like kind of you become a bit more credible when wherein you are in a position to get advances, this working capital issue is going to be there. Okay, I hope this is clear. So you spend at these two stages, then your money comes in the fourth stage only. But this is where you actually book the revenue in the books. Okay, so working capital is equal to the cash locked up just to keep the lights on. Okay, for running this business, you need some fund. That is what is called working capital. Okay. Then three numbers every founder should know. So these are very three important numbers. What be it a service industry or be it a manufacturing or trading entity, this is important for everyone. This DIO is confined to manufacturing or trading, but DSO and DPO is for all the industries. So first thing is DSO. There is days sales outstanding. So days sales outstanding means your accounts receivable divided by revenue into 365, which means that how long customers take to pay you. So for example, you are doing 1 crore revenue in a year. Okay, you're doing 1 crore revenue in a year. And you are outstanding amount at the end of the year is 1 lakh rupees. Okay, so your DSO is 1 lakh divided by 1 crore into 365. So it is 3.65 days. Okay, so what does this calculation means if you ask me? So this calculation is assuming that the sales is happening evenly across the year. So your debtors outstanding is also like kind of even across the year. So if you sell a product today or you sell a service today, how much number of days does it take for you to get the money from the customer? That is what is calculated here in DSO. So that is your accounts receivable divided by revenue into 365. So how long customers take to pay you? So that is what DSO is. Then we have DIO. DIO is not relevant for service industry, but for manufacturing and trading. So to discuss the cash cycle, we need to discuss these topics. That's why I've included that as well. So DIO means days inventory outstanding. So the formula for that is inventory divided by cost of goods sold into 365. So how long inventory sits before it sells, which means that, so for example, you are having 1 lakh worth of inventory and the cost of goods sold is say 10 lakh rupees. Okay. So you get inventory is 1 lakh divided by 10 lakh into 365, you get 36.5 days, which means that once you make a material or once you make a product or like kind of for make or you procure a raw material from the market for making the product. So you procure that, you made it into a good, and finally you want to sell it. So that time period is calculated here. How long the inventory sits before it sells. Okay, so that is what DIO is. Then we have DPO, which is days payable outstanding. So this is just the opposite of DSO. So here what we are doing, accounts payable divided by cost of goods sold into 365. Okay, so how long you take to pay suppliers. So this means that you are having a, see here cost of goods sold is relevant to manufacturing or trading, but in service, it's your total like kind of indirect expenses also. So accounts payable means how much amount you have to pay divided by COGS, cost of goods sold into 365. So for example, let us take the example of a service industry. You have overall expense of say 1 crore rupees. And 25 lakhs worth expenses is outstanding at the year end. So which means that 25 divided by 1 crore into 365. So that is going to be your, so that's coming somewhere around what, 91 days approximately. So you typically get a credit of 3 months from your suppliers or your vendors or your whoever it is. Okay. So these are the three critical numbers. It is DSO, DIO, DPO. Okay, I hope this is clear. Now we come to cash conversion cycle. So cash conversion cycle is equal to DSO plus DIO minus DPO. So DSO is what? your accounts receivable days, like how long it is outstanding. DIO is what? Your inventory outstanding. DPO is what? Your payable outstanding, like how much days of credit you typically get. So this is the formula for calculating your CCC. That is a cash conversion cycle. If the CCC is positive, it means that you fund your operations. Higher the number is equal to more cash needed to stand still, because your customer pays you only after a while when you raise the invoice. There is a longer waiting period there. Your inventory stands in your inventory for longer days. And your creditors doesn't give you that much number of days of credit, so it is lower. So that is why it is positive. If negative CCC means suppliers fund you. For example, Amazon, Quick Commerce and all, they get advance payment. For example, even if you are a credible brand, you get a lot of advance money. Just imagine your DSO, like you get this invoice at the moment you raise it. Okay. In that case, your DSO would be 0. You don't have inventory, so inventory is 0. But your customer, your vendors give you like 30 days of this one. So it's going to be negative 30, which means that since your vendors are giving you 30 days of credit, you are able to manage your business and also since your DSO is very less, you are able to manage your business in a good manner. Okay. So positive CCC means you fund your operations, higher number is equal to more cash needed to stand still. Negative CCC means suppliers fund you, like Amazon, Quick Commerce, and all those D2C brands. Okay. Then let's go for a live case. Company X, year 1. So a profitable B2B services business, the kind of business we see every day. Okay. So the revenue is 10 crore, EBITDA is 2 crore, PAT is 1.5 crore. Okay. So their DSO is 90 days, DIO is 60 days, and DPO is 30 days. So what is the cash conversion cycle? It is 90 plus 60 minus 30. So DSO 90, DIO 60 minus 30. So it's 120 days. So what is the working capital tied up? 3.3 crore. How we arrived at 3.3 crore? It is 10 crore into 120 divided by 365. Okay. I hope it's clear. So this means that of the 10 crore revenue that you have raised, for you to kind of run this business, you need 3.3 crore of cash in your hand to stay alive. Okay. Now, year 2, the founder, same business. In the second year, they are doubling the business. Okay. Revenue grows 100%, margins hold. Cash conversion cycle stays at 120 days. Again, they generate another 3 crore of revenue. But for generating 3 crore of additional revenue, additional profit, they would be requiring 3.3 crore upfront cash. Because their cash conversion cycle is at 120 days. So for them to generate 120 days of, another 10 crore of revenue, they need 3.3 crore of upfront cash. Okay. So that's where the difference is. You just imagine the profit is 3 crore, but you need 3.3 crore to make this 3 crore profit. So that is why your business shows profit, but you don't have cash in hand. So this is the growth tax. The profit goes into receivables and inventory. It is on the balance sheet. It is not in the bank. Okay. So you have spent most of the money to buy inventory, and you have given credit to all your customers as well. Okay. So that money is gone there. Now 3 levers before you borrow a rupee. This is an efficient way of how to manage your business in a very cash effective manner. First thing is reduce your DSO, like pull cash in faster. So tighten new customer terms. So once you have achieved a bit of credibility, or you believe that customers are approaching you, try to get some advance. Okay. And if they are making the payment, so if you're giving a 30 days credit or say 60 days credit, maybe there could be some standard terms, because in your industry, other people are giving 60 days credit. So you may not be in a position to ask them to give advance amount. So even if you're giving 60 days, even if you're forced to give 60 days of credit, tell them that if you pay within 30 days, I'll give you 2% discount or something like that. So that cash comes into your business. Okay. Then name the owner for collection. So there should be somebody designated to make the collections. Typically, what we see is that everybody is behind revenue and profit. Nobody is there to track the collection, and there is nobody to take accountability of the collection. An accountant would be following up, an accountant would be sending the mail, but there would be no action from the customer side. So there should be an ownership from somebody's end. Okay. Then increase DPO. Push cash out slower, which means that wherever you are onboarding with another creditor or vendor, ask them for more credit days. Okay. For example, if you have somebody whom you have been working with for a while and they have been giving you 30 days credit, ask them for 60 days credit. Okay. So that your cash flow would look much better. Then vendor finance schemes and avoid prepayment. So like avoiding like advance payment. I mean, that's just the opposite of what I told there. So in your business, it's always good to buy advances. But again, in your business, it's not that good to pay advance to another person. Okay, so it's actually a contradictory thing. So that is where you'll have to negotiate good terms with the, these sort of people. And vendor finance scheme means some invoice discounting or such sort of thing, wherein typically, for example, if they are giving a 30 days credit and you have an invoice discounting or some sort of scheme like that, the vendor is settled there. And then you make the payment to the bank or someone who is invoice discounting at a like kind of a later stage. Okay. Then reduce DIO, hold less inventory. So inventory, like kind of, there should be some ideal inventory which you will have to hold in your business, but that should never go up. So there should be an ABC analysis on stock. So which are fast moving items, which are more important. So there could be slow moving items which are valued at a very higher rate. So there is this Pareto rule. So 80-20 rule applies everywhere. So there could be like kind of 80% of the number of items would be only 20% of the value of the stock. Okay. Whereas 20% of the number of items would be 80% of the value. So in that 20% of which has high value, if there are slow moving items, don't buy those stock again. You need to analyze at inventory level, which is moving, which is not moving. The moving items you can buy in required quantity, but the items which are not moving, don't buy that in a more this one. Okay. Then quarterly liquidation review. Review your inventory levels every quarter. If you need to like liquidate off some stock, do that. Then bill weekly, not monthly. So you need to like follow some pattern wherein you do like if at all you are able to bill daily, that's well and good. But don't follow for a monthly billing pattern wherein just to kind of have a uniformity or just to standardize the operation. If you do that, you are actually playing a lot or like you are losing a lot on the cash flow. So drop CCC by 15 days on a 20 crore business, roughly rupees 80 lakh of cash freedom. So if you reduce the cash conversion cycle by 15 days in a 20 crore revenue business, you are ideally making 80 crore free to deploy in your business. Maybe you can hire new people or like you will be having more breathing space in your business. Okay. Then next thing. So, okay. So why debt, not equity for the working capital thing? So for working capital, typically we don't go for equity thing. So there is a reason behind it. First thing is equity is the most expensive money. So most of the people see as equity as the cheapest option. Why? Because you don't have to repay, you don't have any interest payment or anything. But you are actually giving your permanent ownership of the company for a temporary cash need. In most of the cases, working capital requirement is temporary. Okay. For that, giving a chunk of your company to someone for lifetime is a foolish thing. Then working capital is recurring. You will need it again next year and the year after. So each time you cannot raise equity just for working capital needs, which means that eventually at the end of 5th year, the 100% of the company would be taken by somebody else. I mean, that won't happen, but still I'm telling. In a hypothetical situation, if you keep on taking equity, that's what's going to happen. Then lenders are open today. Banks and debt funds are far more comfortable than 5 years ago. So the lenders have come up with newer schemes. There are revenue-based financing. There are a lot of kind of new instruments available in the market, which are flexible to the needs of the founders. So explore that as well. So equity for risk and one-time bets, debt for predictable recurring needs. Okay. So if your requirement is one time, for example, you need to set up an office, you need to set up a factory. For that, you raise an equity. But if it's for working capital, you need to buy more inventory for this particular Onam season or like for Diwali season. That means that you need to go for a debt. Now we'll come to the second part, debt instruments. We'll discuss about 6 instruments. So the first one is cash credit or overdraft. So most of you might have heard this. So cash credit or overdraft is simply like a negative savings bank account, I would say. So it's like you get a limit up to 5 lakh you can utilize in negative. So for example, if your bank today has 1,000 rupees in your bank account, okay, and bank gives you a cash credit, which means that you can use that till 5 lakh, 1,000 you can use it. Okay, so that is how typically cash credit works. So the benefit is that you are getting some cash upfront, and you can actually put in the receipts in this cash credit account, and you can make your salary payments and all those payments also through this cash credit account. In that way, your working capital is managed in a proper way. Okay, so it's a revolving credit limit, pay interest only on drawn amount. So that's why you have to put in your collection into that account. So interest is always calculated on the midnight of the same day. So for example, today's interest would be calculated at 11:59 p.m. 59 seconds. So whatever balance you have or whatever balance you have withdrawn from the cash credit account and what is the balance at 11:59 seconds, on that amount the interest would be charged. So if you can keep in more money in the cash credit account, that means that your interest will go down. Then CC is against stock and book debts. Overdraft is typically against FD or property. Then drawing power recalculated monthly, submit statements on time. So drawing power is, for example, even if you have 50 lakhs of cash credit, that doesn't mean that you can withdraw 50 lakhs. There is something called drawing power. So drawing power is determined based on the stock and debt statement that you submit to the bank every month. So if you're so typically they have 75% of the stock and 60% of the debt is what bank typically would be giving anyone. So if you are having a business and you have 50 lakhs of cash credit, which is your limit, the drawing power can be much lower than that. So just imagine your stock is 30 lakhs. So 75% of 30 lakhs is what you get as get on the stock amount. So 75% of 30 lakhs is what, 22.5 lakhs you get there. Then on your debtors, you have 20 lakhs. On debtors, you get 60%. So that's 12 lakh. So 22.5 plus 12, 34.5 lakh would be your drawing power. Still, your limit would be 50 lakhs, but you can draw only up to 34.5 lakhs. And in the next month, when your debtors and stock increases, you will be able to draw more. So the typical indicative interest cost is 9 to 12% per annum, and it's a revolving kind of account. Then we have a working capital demand loan. This is best for a chunkier time-bound working capital need within the working capital line. So we call it ad hoc limit also. So this is where you are into a business of some sort of seasonality. For example, you are in the business of firecrackers or and during Diwali or Vishu in Kerala, that is where you would be having most of the sales. And for doing that sale, what do you need? You need to buy raw material, you need to make these crackers and all those things. At that time, you need money. And you are quite sure that business is going to happen and you'll get money during that time. So for that temporary kind of thing, you can take a working capital demand loan. So typically that is given as a top up to the existing cash credit or overdraft facility. And we call it ad hoc limit also. So again, interest would be 9 to 12% itself. A typical tenor is 3 to 6 months. Okay, so this is actually a limit within the cash credit or overdraft. So sub-limit carved out of the overall CC line, slightly cheaper than CC because the tenor is fixed. So since it's 3 to 6 months, you may get at a lower rate. But in some cases, people charge 2%, banks charge 2% extra for additional limit. Useful for bulk inventory or large customer order ramp up. So even in case you get a bigger customer order, you get a very big export order this time, which you never expected. And you don't have money to fulfill that order because you don't have stock in place and all those things. So at that time you can, but since you have a cash credit, what you can do is that you can approach the bank and ask for a working capital demand loan. So they will give that to you and you can repay it in next 3 to 6 months time. Then we have term loan. Term loan is best for capex, long life asset, one-time investment. Okay. So for example, if you want to buy a machinery, if you want to buy a factory, in that case, you can go for a term loan. So because the benefit that you are going to derive from this product is going to be a longer period. And term loan typically like kind of is for a 3 to 7 year period. It's not a revolving account. So once you take, you'll have to repay with interest within the timeline that they have committed. And the indicative cost is 10 to 13% per annum. Okay. So it's fixed amount, fixed tenor, structured EMI or balloon. Balloon means like you can pay in one shot. At the end, you save the interest upfront, that sort of scheme. Then use for plant, machinery, fit outs, infrastructure, vehicles, etc. Never use a term loan for working capital. Tenor mismatch hurts. So if you start using working capital for working capital, the problem is that you may not be able to repay that in a proper manner. You'll have to pay the EMI every month. And once the full amount of the term loan you have used it and you're repaying the EMI means that your working capital would be affected badly because this repayment also comes there. In the other case, you are paying only interest. So the repayment amount or the interest amount that you're paying would be comparatively less compared to the EMI that you pay on a term loan. Then we have non-convertible debentures. It's best for large borrowings when bank limits are saturated. For example, you have utilized almost all of the bank limits, then you can go to some AIF or some sort of venture fund and avail a non-convertible debenture. So it's again another debt instrument. The cost would be much higher. It would be 11 to 16% per annum. Even I've seen it go up from 17 to 25 also. There will be a tenor of typical 2 to 5 years. So it's privately placed, listed or unlisted, secured or unsecured. That depends on the people whom you're dealing with. Typical ticket size is rupees 25 crore plus. Below that also it's there, but it doesn't justify the issuance cost. Like there are a lot of compliance costs also associated with NCD. Then investors, NBFCs, family offices, AIF, mutual fund like that. Then we have venture debt. So it's best for VC-backed startups extending runway without dilution. So if you are a VC-backed startup and you need some more money for the runway, but you are not ready to dilute at this point of time, you can go for a venture debt. So the indicative cost is 14 to 80% all in. Then typical tenor is 24 to 36 months. So lend on the back of your equity round, not EBITDA. So why you are getting the money is because, okay, you are going to raise fund in the future. So that's why you are given a venture debt now. So you can repay it once you raise the fund. Cost includes interest plus warrants. What's the warrant? So there will be a lot of conditions also coming along with this venture debt. So watch out for that. Active in India, Trifecta, Stride, Alteria, Innoven, Black Soil. These people are active venture debt companies in India. Then we have revenue-based financing. This is actually a very, not very new, but a newer concept here. So this is best for predictable revenue businesses like SaaS, D2C subscription model kind of business. The indicative cost is 18 to 30% annualized, so the interest is much higher. Typical tenor is 6 to 18 months. So here, repay as a fixed percentage of monthly revenue until 1.1x to 1.4x. So whatever they have asked for example, if they are giving you 1 crore, they would be wanting the return in next 6 months. And they would be wanting 1.1x, which means that 1 crore 10 lakhs would be the overall repayment that you have to pay. And that's actually repaid as a fixed percentage of the monthly revenue. And since you have predictable revenue, since you are or you have a lot of retailer clients, or you are a D2C business, wherein you have like a predictable kind of revenue, then it can be structured as a percentage. So there is no collateral, no personal guarantee, no dilution. Nothing is there. Okay. Active in India, we have Getvantage, Club, Velocity, Recur Club, and all. So this is purely based on your revenue, purely based on your GST returns and all those things. Okay. Now the decision matrix. So what sort of fund to go in what sort of situation? So day-to-day working capital gap, you should be going for cash credit or OD. Cost is 9 to 12%, tenor is revolving. If it's a time-bound working capital chunk, you should go for working capital demand loan, which means that you have an ad hoc requirement, you have a seasonal requirement. At that time, you should go for that. 9 to 12% is the cost, 3 to 6 months is the tenor. Then if you have any capex or new asset building, then term loan, you have to go for term loan, 10 to 13%, 3 to 7 years. Then if it's big ticket, banks max, like you have run out of banks, go for an NCD. The interest rate is 11 to 16%, 2 to 5 years is the tenor. If it's for runway and you are a VC-backed startup, go for venture debt. The cost would be somewhere around 14 to 18%. Tenor would be 24 to 36 months. Then if you are sure that your business is growing, your revenue is going to grow, and you're quite sure, like if you have a predictable revenue, a minimum revenue coming in, go for a revenue-based financing. Even though the interest is much higher, it could be a. I mean, since it's for shorter periods, for 6 months and all, this can be a better option. Okay, so the interest cost, like I've told, it's somewhere around 18 to 30%. Tenor is 6 to 18 months. Short use short money, long use long money. That's the simple rule that you have to follow. Okay, so 3 things to do this week. Like compute your cash conversion cycle. Pull the last 12 months and last 3 months, and compute the DSO, DIO, DPO, CCC. That's the 30 minutes of the work. Pull internal levers first. Tighten DSO, like I've told, make the collections fast. Stress DPO, ask for more credit from the vendors, more credit days from the suppliers. Reduce DIO. Don't put your inventory much on the much in your this warehouse. Try to sell it off fast. 1 full quarter before signing any new debt. So in the first quarter, what you have to do is you have to calculate your CCC. Then in the next 3 months, you work on these internal levers. Then see how your cash conversion cycle has improved. Then match instrument to need. So if at all, you still need cash flow, match the instrument based on your requirement. If you need day-to-day working capital, go for a cash credit. If you are looking for a capex, go for a term loan. If you are looking for runway, go for venture debt. If you are very sure that your revenue is going to scale in the next upcoming months, but you need some cash flow immediately, go for a revenue-based financing. So the closing question is, what is your CCC right now, and what's one lever you can pull next week? Okay, so take this question seriously. And I think that's it from my end. Now over to you guys for asking questions. The link to join the Jargon Buster webinar group and my LinkedIn link is also there.
Yeah, thank you for the session. So if the CCC, that calculation, if it should be negative, then it is good. Am I correct?
Yeah, it's that way. Yes, correct.
If see that cash conversion cycle is more, then means we are in a problem.
I mean, I wouldn't say you are in a problem. Again, it depends on the how much money is blocked. So if it's a very small number of days of cash conversion cycle and your business is making still good amount of money, that means that it may not be that problematic for you.
Okay, thank you.
Yeah. Anyone else? Okay. I mean, if there are no more questions, we'll wind up the session. So once again, thank you everyone. Thank you everyone for joining and supporting the session. So we'll have the next session probably on the next Friday. I mean, not next Friday, the Friday after next Friday. So 22nd of May. We'll update you with the topic and stay in touch. Yeah. Thank you everyone. Bye. Have a good weekend.